Well, good afternoon, everyone. Welcome to this afternoon's webinar hosted by the MGAA, How to be a Streetwise MGA in a Changing World. It's the 23rd of July. We do know that, not the 23rd, but I think under lockdown conditions, we've all sort of forgotten what day it is anyway. But I'm very delighted to have you all here and joining us. Had a slight technical issue this afternoon. One of our panelists is still being parachuted in, and I'm sure they'll arrive very soon. But beforehand, just a little bit of housekeeping for you. So all of you joining us now, and I can see you all coming in, are automatically muted, so you can't heckle. And but if you do want to ask a question, and we do invite that, please use the chat function, and I'll be alerted. There's a Q&A session at the end of this webinar. So really send us your tough questions, please. This webinar is being recorded, and there also have been some media invited to join the webinar. So I'd remind the panelists that this is an on-the-record event. And also don't forget your feedback forms at the end for the MGAA. Thank you. So I'd just like to introduce the panel now. So it's a great pleasure to have with us Charles Rowley, the Director of DA Strategy, Bruce Carman, the Chief Underwriting Officer at Hive Aero, both of whom you can see there with me, and Martin Roffey, Executive Director at Willis Alternative Distribution, who we feel will be parachuting in any minute now. So first of all, let's just go through the learning objectives. We want you to come away with some real practical insights and tips from this webinar. It's not just going to be a talking shop, and we've thought long and hard about how we can structure it so that you do come away with something practical. We'd like you to be able to better align your business and growth objectives with carrier partners. We're going to have discussion on how to obtain capacity, and how to best recognise how MGAs can demonstrate their value in a tangible way to their capacity providers. Also a little bit on DA relationship management and operational fitness for the future, touching on technology there too. So without further ado, I'd like to introduce the first topic, and this is how MGAs can demonstrate their value to carriers. And I think Bruce, this is possibly something that you can opine on, so why don't you fire away?
Thank you, Helen, and good afternoon, everybody. I hope you can hear me, because I know that one of our panelists is having a slight trouble. Streetwise MGA, not my title. I don't think my daughter, my 19-year-old, would suggest that I'm streetwise in any way, shape or form. However, I do run an MGA. I did set up an MGA 3 years ago, Hive Underwriting. Currently we have 3 binding authorities. And what is a streetwise MGA? Well, in my opinion, a streetwise MGA is obviously a managing general agent working on behalf of carriers in a cost-effective way. So unless we're going to add value, we don't have an existence, in my view. So we have to do something different. We have to be effective. We have to be efficient. We have to be profitable, and I think we'll come on to that a little later, because that's one of my key drivers, is that this should be a profit-derived relationship, and if it's not profitable, then you kind of question your longevity in this and how long you might be employed by your carriers that you're working on behalf of. So that's my key real driver, is profitability and adding value in that regard through cost savings and efficiencies. In the old days, and I talk about the old days because I've been around for a few, I was an underwriter at Lloyd's for 30 years, and the dream was always to be an underwriter at Lloyd's in as much that I wanted to set up my own syndicate. However, the cost of doing so is prohibitive. So an MGA does give one the opportunity of underwriting in a fashion which one would as an underwriter in Lloyd's, on behalf of Lloyd's carriers potentially and other company markets. And I think, you know, the cost basis, and I know that Lloyd's now has a syndicate in a box, which is a very welcome addition from the future at Lloyd's. But prior to that, certainly creating a syndicate at Lloyd's was the domain of very few, because it required so much money, so much structure, and hence a lot of people like myself have turned to an MGA. So I think that's probably enough from me. I'll probably hand over to Charles, who's been integral in part of the kind of development of Hive up until now, and I have worked in cohort with Charles for some time now in developing what we have done. So Charles has a wealth of knowledge in the delegated area.
Thank you very much, Bruce. Yeah, I think adding value for MGAs to me is an ever-changing environment, and in fact, deeply complex, because it very much depends on what type of MGA you are, what your class of business is, and of course who your carriers are. In the old days, I used to think of, well, MGAs as sort of falling between in two different areas, one more distribution orientated and one more underwriting orientated. But I think that's a vast simplification. So I think those are definitely two key aspects that a successful MGA has to deliver to its carrier, so that an underwriting profit can be delivered. However, there are all sorts of other reasons that a carrier, will approach an MGA and want to do business with an MGA. It's not just distribution or underwriting expertise. It can often be about portfolio diversification. So how do I diversify my portfolio to make to increase my capital efficiency? It can be a cheaper way to underwrite business. It is, I think, as many of us know, it's expensive for carriers to hire teams of underwriters in specific areas of business, and MGAs can very often, particularly for those smaller carriers that are growing their portfolios, provide a much cheaper and more flexible alternative for carriers to engage in the marketplace. Another area is, of course, access to innovation. Most carriers, by their own admission, are pretty slow at developing new systems, new IT, and using technology to get into some of those new niche markets. The insurtech arena, I think that's absolutely, where MGAs can add a lot of value to insurers by demonstrating how some of these new innovative IoT devices and things like that can deliver for them. And lastly, I think, it's all about, actually, MGAs often provide much better service and have much better systems than the carriers themselves. I think COVID has actually demonstrated that. I think MGAs have coped with the COVID situation with their remote working, their agile systems, their more up-to-date structures and things than many carriers. Carriers who've had to rely on call centers have often, unfortunately, fallen short. So I think it's actually been a situation where MGAs can and have demonstrated, real value to the market. But I think overall, I would say that for an MGA to really get to grips with the value they're adding to their carriers, they need to understand and really develop close relationships with each of those carriers and understand, so why is that carrier working with me? Why is that underwriter working with me? And it may be you have a number of carriers and they are working with you for quite different reasons, and therefore identifying what they might be among some of those that we've just discussed is going to really help add understanding and allow MGAs to deepen that relationship in what is now, as a strongly hardening market, a harder place to get capacity.
Absolutely, Charles. And I think those themes of partnerships and the technology theme is something that we're going to touch on a little bit more detail later. And the irony was not lost on me that the first mention of the word technology also came with it a sort of stuttering of your screen too. I think as we're all conducting business via webinar these days. But what I'm hearing is it's more than just a cost play, although that's clearly a factor. But the MJ model has this nimbleness and also a sort of crucible for innovation, proving ground for innovation that can be very useful to a carrier. And I'm going to invite Martin, if he can hear me, to jump in on this point. Are you there, Martin? I'm going to take that as a no, and we can we'll parachute him in on a technology question later to explain how this has come to be.
Can you hear me now?
I can. Fantastic. Well done, Martin. Did you hear the question I just asked?
Actually, I can see everything. I can hear everything. Unfortunately, the hamsters don't work very well in Suffolk, when it comes to collecting or connecting the dots. So
that's no problem. Thank you for battling through the wilderness to join us.
That's all right. It's okay. So I was listening, but the last part, can you just repeat your question, please, Helen? Absolutely,
Martin. We were just making the point that the demonstration of value is more than just a cost play. It seems to be the idea that the MGA is more of a proving ground for innovation. And I wondered what your thoughts were on that subject.
Well, essentially, the things that Charles and Bruce mentioned, it's an amalgam of all of those. I mean, you have to prove that you have expertise. You also have to prove you have distribution. All of those things are very important, and so therefore you add value to the value proposition of any insurer, and whether or not the insurer feels they actually have the expertise themselves. As a general rule, what you're trying to do is to create a streamlined and more specific structure that enables the insurer's brand to be more thoroughly recognized. And to Bruce's point, if you do the job properly, you produce better profits for all concerned.
Well, brilliant. Thank you very much, Martin. I think actually that segues quite nicely onto a deeper exploration of the partnership theme and what exactly that means for an MGA partnering with a carrier and vice versa. So perhaps, Martin, you'd like to just start us off with that one?
Sure. The first observation I would have on any of this is that it's really important to work out what makes your partner tick as an MGA, because each insurer will all say they want profit, but some have emphasis on different things. Some are more interested in data. They're all interested in these things to a lesser or greater extent, but if you think about the things that in your negotiations with any insurer, the things that they mention probably more than once or twice will be the things that as an MGA I would concentrate on. So if someone says, I'm really interested in distribution, how do you go about making sure that you deliver our view on this particular line of business to your insureds? Then they say that more than once or twice, I would concentrate on that, but I would also make sure that you become indispensable to them. And therefore, that doesn't mean just talking to the underwriter that you're talking to. It's talking to everybody that's in the chain, value chain. Because if you think about it in these terms, if there are three of you doing the same thing, what is going to separate you from the others? And generally speaking, you need to make sure that when an underwriter is asking the people that work with him on the reasons why they should do business with one MGA over another, it may actually boil down to, well, they're very good at responding to any of the queries we have. They're very good at paying claims. They're very attentive. They like talking to our people who are responsible for data collection. If you can basically tick as many of those boxes as you possibly can, then you'll find that as an MGA competing with others, if they don't actually pay their claims on time, if they're not very good at responding on the telephone, the underwriter may see the loss ratios are all very similar, but that will be a defining factor of who is chosen to continue as opposed to those who are not. So it's important to understand who your markets are and what are the things that drive them. So it means you can create a better partnership overall.
A very good point. Bruce, make yourself indispensable to the carrier.
Well, one's trying to call me right now, so I guess that's not the definition of indispensable, is it? Because I'm predisposed. But I'll get back to him when I can after this call, I'm sure. Yes, totally. I mean, what I'm looking to do, and again, I'm talking about myself here because I respect the fact that, as Charles alluded to, there are many different forms of MGAs. You know, you have distribution models where people really, I see them akin to a broker. Then indeed there are many broker MGAs out there. We're very much on the other side of the fence, which is the underwriting side. So we're very much focused on profitability. So how does that look for us? Well, we make ourselves indispensable by making sure that we do things in a way that maybe the carriers can't or don't. What does that mean? It means pricing analysis. So let's start with what we call knowledge-led underwriting. We take as much data as we possibly can. We try and digest that data, slice that data. And let's talk about insurance. You know, premiums of the many paying for the losses of the few. Well, it's all predicated on historical statistics. We're trying nowadays to be more acute and to try and forecast. But I can tell you that 6 months ago, actually let's go 7 or 8 months actually prior to the beginning of the year, the talk wasn't of COVID, it wasn't of pandemics. The talk, you might recall, in the marketplace was of cyber and what cyber potentially looked like in the market. So absence of cyber loss in the aviation, and I specialize in aviation at the moment, absence of loss in aviation market caused by cyber, we have to guess what that might look like. So we try and model these things. We try and work out what, prior to a loss, what that might look like. So then we come on to exposure analysis. So that phrase I used, knowledge-led underwriting, really comes from analysis of the pricing. How much is an adequate price? What is the price adequacy? And what's the profit margin that we estimate? So if I'm going to estimate a profit margin to my carriers, I want to be realistic about that. I'd rather under-promise and over-deliver. And that way I'm hoping I've got a happy customer, a happy carrier who will stick with me. If I say I'm absolutely brilliant and I'm never going to have any losses, I don't think too many people would believe me. After all, we're in the game of paying claims. So that's the start point. Be realistic about your loss ratios and what you're likely to achieve. Hopefully you can then knock the stars out. Then kill them with kindness. Give them as much data and as much intel as you possibly can. Here we are, just analyzing with multiple data feeds, and actually one of my biggest costs, apart from the premises and the people, which are, they're lovely people and I'm very happy to pay them, but the key cost of ours is intel feeds. So we're digesting loads of data in real time in order to then try and get a better steer on what we're actually underwriting. And from there, once we've underwritten or accepted that risk, we then want to report on it in a very timely manner to our clients, the carriers, and I say our clients because we're slightly betwixt and between, bearing in mind we're an intermediary as well. So we are beholden to our brokers, beholden to their clients, the airlines, and also on the other side, much like shareholders, beholden to the carriers. So we kind of see ourselves a bit like a fund manager. And are you going to give your pension pot to somebody when you think you can outperform by stock picking at home? And the answer is no. So we have to do something different, and our analysis, and again, we've chosen to spend a lot of money on data analytics and an analytics team who provide us with exposure and the RDSs, the realistic disaster scenarios, which again make the life a lot easier for the carriers. So the carriers can then say, they can go to their underwriting management or their board members and say, Hive have got this thing under control. They very much know what they're doing, and here are the answers to all of the questions before they've been asked. So that's what we try. We try and preempt really what's likely to occur in that chain. And as Martin said, you know, add value. It has to be added value to the insurer. Otherwise, we're just taking a fee for no good. So value added is really our aim.
So Charles, it's not just a relationship based on commission structures. We're looking at a real partnership with carriers here. Is there anything that you would add to that?
Yeah, I mean, I think I would add the word trust. And it's about developing that trust with the carrier in every way possible. So making sure you're a trusted underwriting partner, making sure you provide trusted service to the customers, making sure that your data and reporting that you provide to the carrier is accurate and trusted, making sure you're trusted to make the payments on time and that they flow through properly. If you handle claims, that you're trusted to handle those claims effectively, and that, you know, when a claim happens, you don't just sit back and say, oh dear, there's a claim. You actually, right, how can we deal with this in the best possible way, but how can we learn from it? And I think that's what Bruce was covering off. So absolutely try and act on behalf of the carrier as if you were, you know, your own small insurance company. And in that way, you end up being trusted. I remember it would probably be about 15 years ago, back when I was young, when I first got involved in delegated authority in the North American market, sitting down with one of our senior underwriters at Catlin, and he's saying to me, look, I trust this MGA. I know that in a hard market, he's going to grow the portfolio up to a, you know, he's going to grow the income. He's going to grab that business when it's at a good rate. And then as the market softens, it's going to drop off again. And his income is going to drop off because he will be placing it elsewhere. And then when we get another hard market again, it'll grow up again. And I think that's the sort of demonstrable actions that you know, carriers really value in MGAs. And it's not only doing it, it's also evidencing it. So actually being able to show through your regular reporting to underwriters, to the carrier's delegated authority team on, you know, the boring stuff, which obviously I've dealt with for many years, the compliance, the bordereau team, the claims team, the finance team, the ags team, even the actuarial team, and possibly sometimes a reinsurance team, demonstrating to all of those different parties at the carrier that you absolutely know what's going on, you're absolutely professional, you're absolutely on top of it, and that the data and the information you provide to them is, you know, accurate, quality, and ideally better than they can do themselves, which is, you know, it's a challenge, but it's definitely doable. So that, in my mind, really helps build, you know, great resilience with your carriers.
Thank you for that. Martin, is there anything that you'd like to add on this point?
Yeah, I think that one of the key things to actually touch on in a bit more detail is what separates one MGA from another. And I think, you know, the partnership part of this is all MGAs, all insurers, they're going to have losses. The key part of it is to actually think, okay, if I was the underwriter here with the capacity, what would I do? Yes, we want to pay the claim, but what do I need to do to demonstrate that I am thinking on behalf of the market that I represent? And as a general rule, what I look for in an MGA is someone that, when they've paid losses, they're able to say, well, we've actually noticed there's a trend here. We've paid 2 or 3 losses, and we've realized that perhaps we shouldn't be writing these particular accounts with, you know, a deductible of, I don't know, 500. We've decided that we're either not going to write this particular type of business, or we're going to actually put a higher deductible on there. Or if we've looked at the loss and we think that in order to mitigate any others, we're going to institute some different risk management. If you go to an insurer and say, well, I know we've had losses, but this is what we've done, without being asked, it creates trust. It creates, you know, that the valued partners syndrome, which actually isn't a syndrome. It's a very good principle to follow. So I think if you can actually put yourself in the position of, if I was underwriting, is this a freak event, or is there something I can do about it that's actually going to make sure that I protect the loss ratio of my insurers, and at the same time create that the added value that you're trying to enhance your position, so you can enhance your position with the market that you're representing.
I think that's a very good point. You know, claims and losses, they're part of our industry, but it's how you react to them that counts. And this proactive approach, this treating it as a learning opportunity, and ability in particular to identify trends and react accordingly it would be of huge value to a carrier, I would have thought. Bruce and Charles, is there anything else you'd like to say on this partnership point before we move on?
I think that's a really interesting point, actually, Martin. And I agree. I mean, I call it underwriting. You know, I'm very proud, I guess, and possessive of my figures. You know, my figures are the carrier's figures, and it's my reputation. You know, that partnership that I'm building with the carrier. You know, I think the start point for us was to basically go out there and say, we'll do this, and most of our income, most of our remuneration will be on a profit-related basis. Now, you know, there aren't that many people, I don't think, that are happy to do that, because you're basically putting your eggs into that profit basket and saying the pressure's on you to make that profit. But at the end of the day, that should, I hope, create a more sustainable continuity of carrier relationship, a better, stronger partnership. And furthermore, you know, as we expand out at Hive, we're actually saying to people, if you can give us capacity across the board in multiple classes, and this comes back to, I think, Charles and maybe even Martin were talking about diversification earlier. You know, much like a carrier would, whether a company or a Lloyd's syndicate, you know, many carriers look to diversify their portfolios with non-correlating risks. And I call it the kitchen table principle. You know, I want to have more than one leg to my kitchen table. I want multiple legs that don't correlate, so that you can knock 2 or 3 of those table legs over out of 12 or so, and you can still have your you know, breakfast or lunch or dinner off that table because it's still standing. So the kitchen table principle stands, and I'm basically saying to my carriers that if you support us across multiple cells, across multiple binding authorities, then A, if you're leading, B, the level of capacity that you're offering and deploying, C, the continuity of time, you know, years that you support and the number of cells you support. It's like a Venn diagram. And if you sit squarely in the middle of that Venn diagram, then we're going to look to, you know, reduce things like fees and or profit commissions over time in a return back to the carriers. So we basically create more of a symbiosis, I think, between us, which makes us the eyes and ears and hopefully the feeding ground for future you know, support.
Charles, is there anything?
Say that, sorry, Helen. I was about to, because I can see you, but you can't see me, so that's possibly an advantage for everyone concerned. But I think the other point that both Charles and Bruce have made is that when you're actually acting as an underwriter for a line of business, Charles mentioned this, it's important that you make the comment that you're underwriting for profit. Now, that's fantastic at one level. That's a one-dimensional comment to make, because if you're writing one line of business and you're reliant on the market changing so that you can maximize your profit for underwriters over a period of time, so let's say in 3 years out of 10 you can write $10 million worth of income or £10 million worth of income, and your loss ratio is in the 20s, but in the other years it's going to be less income and hopefully not too much change in the actual profit. You can't do that unless you've got multiple lines of business, because what you're trying to do as an MGA is to try to build a profitable bank of business. It can't just be in one, because unless you're writing every single piece of that particular type of business, you're always going to be at the mercy of the way the market reacts. So to the point that Charles and Bruce have made, it's important to establish other non-correlating lines of business so that that attitude of underwriting for profit is going to basically give you the best possible chance of that, growing and also thriving. Because essentially the MGA market, to Bruce's point, is filled up with people who are order takers, and there are also people who are underwriters. And the order takers generally are only really interested in writing business that they think might make money but are not really too sure, but they've created a sort of a level of income that they're loath to let go. So essentially they are not the kind of partner, long-term partner an insurer wants. So I think it's important to say you've got to have non-correlating lines of business, and using that table principle is an extremely good one, because you can still use your underwriting approach of underwriting for profit as long as you've got more than one or two lines of business, it should work.
Yeah, I might just add to that. I think risk selectivity becomes key. You know, if you are truly underwriting, you're not a distribution model. You're not just a throughput for fee. You are, you know, underwriting, selecting, pricing, assessing, and not just accepting but declining. And I think what's key here is differentiating that and saying, okay, you know, personally, I think an underwriter's defined not just by what they write, but more importantly, what they decline and why they decline it. And I'm not going to be that Bateman cartoon underwriter that misses the total loss doing a jig at the loss book. But quite honestly, you know, it is about differentiating your product offering and saying, okay, we don't think that's quite right. You know, we're not quite in the market for that. We're going to decline. Thank you very much. You know, and I think that's really key, is having the principles. And, you know, I think we probably as an outfit have got a reputation for that. I don't want a reputation for saying no, but for being fair and pricing things properly with the eyes and ears of the carrier.
That's a very good point. Charles, any final comments before we move on to our next point?
I think Bruce has, you know, hit the nail on the head there. So, and I was very interested to hear him say, you know, talk about the declinatures. I mean, how many MGAs tell their carriers about what they've been declining? I think it's important to get that message across, as well as what Martin is saying, which is consistency, you know, delivering consistency, delivering to your promises.
Brilliant. Well, thank you very much. And I think this does also lead us into to our final topic, which is data and the impact of technology on the sector. And again, we mentioned earlier about the idea that MGAs have this sort of additional agility and experimentation power because of their streamlined structures to look into data-driven underwriting, to look into the latest technology. And I wondered, perhaps Charles, if I could invite you to speak first, what your experience of that has been.
Thank you, Helen. Yeah, I mean, I wanted to look at this in sort of two ways, and I think, to be honest, I think Bruce is probably better able to talk about using data feeds in his particular class of business. But the area I wanted to raise and to have us consider is about the value of data. You know, I think quite often we're saying, right, how do we develop the data? How do we gather the data? And then how do we share the data with the insurers? And I think that's absolutely a strong theme in the marketplace at the moment. But I think MGAs need to be careful about how much data they share with their carriers and what is the MGA's intellectual property in that data. And I think about, you know, the strategy of an MGA. You know, there are two main strategies in the world, basically. There's the strategy that says, I'm going to be the biggest and the cheapest. And I think of that as the Walmart or the Amazon type strategy. And then there's the strategy which is, I'm going to be a specialist and I'm going to be the best at this niche and I'm going to continue getting better and better and better. And the second strategy is what MGAs do in, you know, 90% of the cases. And to be successful, they have to get better and better and better, and they have to stay ahead of a lot of the other underwriters in that particular niche. How do you do that? Often it's by developing products or tweaks to products, adjusting products, and it's about gathering that extra data. And how, as an MGA, do you protect that data and use that data so that you have longevity? It can't just be taken by a carrier or by any other entity that might want to step in and start taking that risk. So one of the things I would sort of like to raise here in this webinar and suggest that people really look at is, you know, how to, as MGAs, how to protect your intellectual property. You know, is your intellectual property in product design? Is it in rating in specific niches? Is it a sort of knowledge of a particular distribution network that you have and the key people that you know? Is it a lot of that quote data and that information that you've gathered on your clients that isn't strictly policy data? Because obviously the policy data is to a certain extent owned or at least jointly owned by the carrier. But I would like to say, I think in this data piece, it's very important to think about the intellectual property piece. And it's a tough one to manage. I suppose the only story I have in this one that's sort of relevant to insurance, is when I was, again, when I was young, I remember Hiscox getting involved in the kidnap and ransom market, and they developed K&R insurance, and it was one of their big profit centers. And how did they defend that from a lot of, Me Too underwriters, particularly in a subscription market? Well, I think they were quite clever, or I believe they were quite clever, because I wasn't involved myself personally. And they went off and they basically did a long-term exclusive deal with Control Risks, who were the team of people out in the field, a lot of ex-special forces people, negotiators, who dealt with situations where people have been kidnapped and ransoms were being thing. And by going out and locking out that key service provider in that marketplace, Hiscox defended their IP and defended that marketplace quite effectively. And I think as MGAs, we need to be constantly thinking about how can we protect our intellectual property. So I think I've probably banged on enough about that right now, and probably time to pass on to Bruce to talk a little bit more about what he's been doing in a really active way in the aviation market.
Well, thank you, Charles. I guess, back to the original piece, in setting up, I had to offer something that was different. I had to offer something I think that was not just eye-catching or promising or the promise of profitability, but something that was, I think, very different to what most carriers out there are doing. Now, that's not just because they might be legacy carriers and, everyone's got a job and a function and they don't really think maybe outside of their box, but actually, I think everyone knows the Uber model and how that kind of stole market share away from the black taxi rank and other, online, obviously success stories like the Amazon, where haven't missed a single delivery during lockdown, which has been great as well. But our habits are changing, and I think our insurance buying habits are changing, and whether that's us buying our home, our pet, our house and car insurance on commercial lines, I think risk managers in the field of energy, marine, aviation, property, they're becoming far cuter as well. And we're now insisting on greater data, and back to Martin's point previously about, whether it's a deductible or, identifying trends. We can only identify those trends with good data. I am slightly, I have to say, disappointed that, however many months into working in an agile environment, from home or wherever, that we still haven't in the aviation market conquered this electronic submission of risk and automation of risk, and PPL and white space and these initiatives have been amazing, yet there are still people who are very skeptical of them and not early adopters. If we could create the model which, we are a part of the subscription market, so we're not going to mop up 100% of a risk. So I guess there's some frustrations for me there, because I really want structured data coming down a pipe which comes into our machine where we're not rekeying it with the potential for human error. And that way, I think other people do catch up. There are innovators and people who are happy to change. And I think we're one of those. So what we've done is I touched upon it earlier, we have actually spent quite a lot of money on data feeds from some pretty grown-up Intel providers. And, some of them are household or more household names, and some of them not so much, but it is one of our bigger bills. And I think that, that for us is a differentiator. So we're using that data, slicing and dicing it. And more recently, in the past year, we've employed an analyst. Now, who in a stock market world would be picking stock without a data analyst or stock analyst, identifying the trends in the sectors and what's happening in each company? Well, so too, that's what we're doing with aviation. And we're picking it apart and saying, where are the trends? Where are the pockets of profitability? Where are the better operators? And what are they doing? And what are maybe the other people not doing so much of? So it's all about differentiation, and data allows us to do that. And analysts, well, again, I'm not aware of too many analysts in the field that we're in yet as one of the smallest entities in the marketplace, we punch way above our weight because of the analysts and the analytics that we provide from that team. And I think, that's one of the things that the carriers that support us, I think, welcome, is that they ask us a question, and 9 times out of 10, I think our analyst has preempted it and got the answer all ready to go. So I think analytics is really the forward driver here in this marketplace. The MGA differentiator, Martin talked about, or Charles talked about InsurTech, and it doesn't have to be something that's an app and a mobile app and an online system. You can start with, let's get proper structured data such that machines talk to machines through APIs, and we create efficiencies where the huge inefficiencies of data entry that gets replugged. And sitting where I am, I receive submissions from brokers on PDFs, Word documents, PowerPoint. I have to pick that apart. It's in no way structured, and then I have to put it into another machine. It's just time consuming. And that in itself, if we can say, we'll give you a reduction if you can give us the data in a structured format which slots into our machine, then our analytics cruncher can do that job so much more efficiently. And that's just a small part of what we hope to achieve, and I guess be a thought leader in the marketplace in that regard.
I think that's a very good point, Bruce. And, in a market where, if you look over at the fintech market, where electronic trading has just been par for the course for the last decade, if you consider how much heels have been dragged in our corner of the world, it is quite astonishing. And I think the point you make about data allowing an MGA to punch above its weight is a really valid one. Martin, I just want to bring you in just another 5 or 6 minutes to discuss the technology issue before we open to Q&A. So is there anything you'd like to add to that?
Yeah, I'm still working on the facts basis, so I'm probably the wrong person to talk to. What I would say is that there's a small part of me as a contrarian here to basically point out that data is not uniform. And one of the things we come back to being an effective MGA, and that's really the key to this, is do you think that your insurer, the person you're trying to have a partnership with, has a view on the uniformity of the data they want to receive? Because there is still, in my view, an enormous difference. It's catching up and the uniformity is starting to occur. But I don't think it necessarily is the same if you go from the marine to the aviation market and to the non-marine markets. I think there's still an enormous disparity in those markets in certain territories. So I think one of the things you can do as an MGA is to basically think about what can I offer to the insurers that is actually going to create the right kind of environment, so you're not, to Bruce's point, double or triple key entering data. If you can find a way of saying to your insurer, I'm going to be collecting this data because this is what I'm going to be doing with it. We talked about it's important to actually know what risk you're writing. It's also just as important to know which risk you're not writing. So hit ratios are quite important because lots of underwriters recognize them as a very crude starting point for, is this MGA doing the best job they can? So if your hit ratio is 90% in a hardening market, you're probably too cheap. But if it's only 5%, you need to start thinking about these things. But it still comes back to data. It still comes back to you as an MGA saying to your insurers, I'm going to be collecting this data because I want to look at these key metrics which are actually going to help me give you the best possible return on the facility that you've given me. And these are the reasons why. Again, it comes back to the whole point of actually trying to create the right kind of environment, the partnership, and to the point that the other two guys have made, whether you do that with InsurTech only, I suspect it probably won't be InsurTech only, it'll be a combination of things, but I think we like to think as we go forward, and the classic MGA client I would like to have is someone that actually thinks like that, but doesn't use just InsurTech as the only measure, because there's underwriting techniques as well which are also important. So yeah, my perfect client would be someone that's got the ability to use insurtech and data, but they also know how to analyze it to work out where they want to be in terms of producing the right kind of loss ratio for their insurers as clients.
Brilliant, thank you very much. Is there anything else, Bruce or Charles, you'd like to add to that before we move to Q&A?
No, that covers it.
No, thank you.
Okay, we'll have a chance to round off at the end with some closing remarks as well. So I'm just going to have a look at some of the questions that have been coming in. If I can. I might have to stop sharing my screen though. Bear with me. Well, I've got a first question to kick you off while I look at the ones that have been coming in during the course of the webinar. And I think I'd just like to ask you all, listening to you speak from your different perspectives, looking at your careers, if you could start again today, would you start as an MGA? Would you start the carrier? Or would you start as a broker? Which position do you think gives you the most advantage? And while you're answering that, I'll look at the questions we've come through. Bruce, you're smiling, so you get to answer first.
Okay, thank you for that, Helen.
That's okay.
That's a really interesting one, and I like it actually because I think I did earlier. I started life as a Lloyd's underwriter, and did that for some time, and rather enjoyed it. During that time, I guess I was slightly regretful the fact I hadn't started life as a broker. Or a banker indeed. I think they're much more successful. But anyway, I think a broker, by virtue of the fact that to better understand the distribution chain and the pains and the trials and tribulations that one has to go through in order to get the business on the table onto a slip to present to the underwriter, or digitally, let's hope, as I said. I think in my perfect world, I would have started life as a broker. I would have seen the pain, as I said, that one goes through in negotiating with a risk manager. I then possibly would have gone into underwriting for a carrier in the way that I started, and then onto an MGA and doing my own thing. So I think, I obviously missed one piece of that jigsaw, which was the broker distribution part at the beginning. But apart from that, I'm being slightly greedy, I guess. I would have liked to have done all three to see all sides of the equation, really, and finish up where I am now, where I'm having a lot of fun.
Okay. Shall I jump in next then? I liked your answer, Bruce. I mean, I have always been in the sort of carrier space until starting DA strategy, and we still find ourselves largely in that space. I think I would answer it slightly differently. I think I would definitely not change from starting in the London market. I find the London market an area where there are always ideas out there. There have always been thoughts about how can we do this better? What are the different ways of doing it? How can we take on these different risks? So I would definitely have started in the London market, and I equally would like to say that I think having some change in a career is excellent. So having a bit of variety, whether it be frontline underwriting or broking or as an MGA. But I think I would probably plump for ultimately working in an MGA would have been a great place to start because of the size of the team and the agility and the real ability to change that MGAs have. I think the ability to change and get out there and do business the way that we want to do it is the reason I would go in as an MGA.
That kind of entrepreneurial spirit appeals to you. How about you, Martin?
I always wanted to be a professional cricketer, so that doesn't count, does it? I actually, thinking about this, I actually think that the MGA is the last part of that particular triumvirate of jobs to do it well, because I started off in the underwriting fraternity, and I then became a cover holder. And it's only when you go from sitting in Lloyd's, as I was, or sitting in the company market, to Bruce's point, you have absolutely no idea how hard it is to get a piece of business to even sit in front of an underwriter. It really does take quite a bit of work, there is a certain aspect of being an underwriter where you seem to think, especially if you're sitting in Lloyd's, people come to you all the time, and you seem to think that the business almost grows on trees without having the required experience. I don't think you can be a successful MGA, in my view, unless you've either been an underwriter or a broker beforehand. To Charles's point, it's great to go into an MGA, but if you're starting right from scratch, I don't think you can do that unless you've either been a broker or an underwriter or both. And my view would be, if I'm starting again, I actually would be a broker first, an underwriter second, and an MGA as a result of those two. And that I think that gives you the best, if you like, the best appreciation of how difficult it is to be an MGA. So it's not an easy thing to do successfully.
And a part-time cricketer as well.
Being a professional cricketer. No,
part-time cricketer.
Yes. We've had, that's an excellent answer, thank you, and I think we can all appreciate the context that you're coming from there too. And there have been 3 or 4 quite interesting questions come in from those tuned in today too. So I'll just take it from the first one of the first that we had through. Some quite technical questions, but I guess the first one's quite broad. Do different insurers define value differently when it comes to working with MGAs? And perhaps Bruce, worth you starting us off with this one, if you wouldn't mind jumping in.
Me, yes.
Unless someone else wants to jump in first to answer, it's a free for all now.
Charles and Martin might have a better steer on this, but I'm happy to.
They might do.
Almost certainly. One man's meat's another man's poison for sure. When I set my thing up, I thought I had some capacity in the bag, as it were. It was pretty much promised on a plate, and then it never materialized because someone somewhere said, and it went, wow, disappeared like sand through your fingers. And so I kind of think, yes, there are different, and I think it comes down to personalities, politics, timing, individuals. There's so many things that go into the soup, so many things that mix up and make a rich tapestry that really, it comes back to that partnership. You don't make a partnership overnight. I'm currently building out another cell at the moment at Hive, and actually it's taking a very, very long time, and it's somewhat frustrating, and I'm learning to grow some patience, something that I'm not long on in a suit, if I'm honest. And that is required really, because, where some people are very instant in their decision making and say, yeah, I'm all in, thank you very much, they're my chips. Other people are saying, I just need to square away the ULR on the third year in the business plan, and your rates of exchange are slightly different. So they're looking at it from a different lens. And I think no two are the same. But then over time, one hopes that through your multiple cells, and hopefully, the carriers are across those multiple cells, and there's some continuity, as I said earlier, of carriers, then you grow that relationship, you grow that partnership, and you grow that trust. And I think Charles used that word, and I can't, emphasize that enough, really. The trust and the bond that you form really, is the real key to this thing. So yes, sometimes I'm frustrated by the different way that, you would have thought that your leader's got this thing covered and everyone else should fall in line behind them. But then you get umpteen other questions from other followers who, you can't foresee them. They're just left field. So yes, very, very different. And how they differ, there's no one size fits all. Too many variables, not enough time here.
Yeah. I totally agree with Bruce on that front. Different carriers have very different reasons for getting into different classes of business at different times. Sometimes they might have a conflict. They might have another MGA, or they might have an office that is operating in a similar market. Sometimes they might feel that there's better rate per dollar of exposure in a reinsurance market as opposed to a direct, delegated authority market. Sometimes they've got limitations on their aggregates, and different underwriting teams will have different, different approaches. So every carrier is different, and it's very important to try and understand, how do you get the tick with this carrier? How did I get this tick with this carrier, and how do I make sure that I really understand what they're looking for on an ongoing basis and can deliver on it?
Martin, anything to add?
I think the guys have covered it very well, actually. There's not too much more I can add to that, apart from to say what I think we've all said it over the last half an hour to 45 minutes, is that every single insurer is going to have a slightly different view of risk. And as an MGA, the key to your success is picking those that have most similarities and trying to put them into one pot, knowing that there may be two others that might want to write the risk that you've got shared between 5 insurers. You might find there that the 2 others want to write the risk 100%. And if you can get those all to operate in a concerted way, you're going to be good. But there's never going to be, in my view, over the long term, people all think about things slightly differently. But if you make your loss ratio is good, they tend to fall in line. But getting them on board is really tricky, because we're finding more and more people asking all kinds of questions which you think, why are you asking that? But that's what makes our market a market.
Another key point, just to jump in, is that it isn't just independent carriers being different. Sometimes within carriers, it comes down to the individuals within carriers. When I'm thinking about getting support for a class of business, it very much comes down to who do you approach within an entity to get support. And if you have, it is a political game, and it can be, depending on, if you get that thing wrong, then you can burn your bridges. But do you go to the class underwriter if they're in a field associated or similar to what you want to do? And they may feel threatened by what you're doing, at which point that might not be the right gig. Do you go to, in a Lloyd's terms, the active underwriter, or in a company carrier, the chief underwriting officer? Do you go to them, or do you go to the managing director or the top or the CEO of an entity? There are so many different points of access, and each one of those stakeholders within a carrier might have a different perspective. So, there is no one size fits all. It does really come down to politics.
I think that's
you just need to do some broker, Bruce.
Yeah, absolutely.
You need to do some broker, Bruce. That's exactly what the broker does.
While he's not being a cricketer. Just leads me into just one more question. I've only got 1 minute left, but actually 2 have come in on a similar theme, so we can just do a quick fire answer if that's okay. Because one listener asked, what does the panel think of the super MGA that's emerging? And another listener has asked, is there an ideal size for an MGA? A bit like the Goldilocks question, too big, too small. Where do you see this fitting in, and particularly in 2021 as we see the model develop?
Mm-hmm.
Charles?
Okay. I suppose I could jump in on the ideal size for an MGA. I think, bearing in mind it's a niche strategy, it's about having a sufficient size to be a real player in that niche, but not necessarily becoming, I think, so I don't know about the aviation niche, for example, but about developing a sort of market share level of 10 to 20% in a specific niche would be, to my mind, a good ambition to have as an MGA.
Brilliant. I just can see we're on time. So Bruce, any quick thoughts to that?
Yeah, I think 10 to 20%, depending on what size, if you're talking large specialty risk as we are, that's about where we see the thing from a capacity perspective. Back to my table legs, 10 to 12 is where I'm looking. So that's the number of classes that I guess will qualify us at some point as a super MGA. What we're not doing is going out and getting mega funding so that we have a massive mortgage to pay back to somebody else as a shareholder. So just organic growth.
Very sensible. And Martin, your final thoughts?
Pretty much echo what the two guys have said. As far as I'm concerned, there is no perfect size. You can be too small. I don't think it's necessarily, until you start looking at various entities, I think the comments that the guys have made is quite right. If you've got 5 or 6 different lines of business, you could be 100 million, you could be 25 million. It just depends on the profitability of the business you have and how many lines of business you have. So I don't think there is a perfect size, but there is certainly a size where you need to be bigger than in order to do the job properly.
Yeah.
Well, thank you very much. And look, we are at 3 o'clock now, which is when we're supposed to end, but I get the feeling we could carry on talking about this for a long time. And look, Charles, Martin, Bruce, thank you ever so much for taking the time to have this debate today. Huge thank you to the MGAA for hosting this. And if any of you listening felt that there's something you'd like to follow up on, or if we didn't quite get around to your question, then do please contact us through the MGAA, and we'll be there to help answer your questions. And don't forget to fill in those feedback forms. They'll be very useful for the association. So thank you again, the 3 of you, for taking part.
Okay.
Thank you.
Thank you, Alan.
Thank you very much. Goodbye.
Thank you, Alan. Bye-bye.